Sorry for the mute. I keep it short and sweet. I don't want to be here for 2 hours chit-chatting. Morning briefing is hit and miss. We got to go, right?
No worries. Thanks.
Yep, we can chat after. Hopefully everybody had a good weekend. It looks like it's going to get nasty out there. Good thing I detailed the bike and put it away. It won't be no more riding this year. Oh, yeah, I'm sure somebody's going to go out riding it, but I'm not going to go out riding in it. All right. Good morning. Good morning, everybody. So over the weekend, we heard that there may be an end in sight for the government shutdown. That's only on the Senate side, so it still has to go through the House. They can still throw up a lot of procedural hurdles. Just because you see light in the distance doesn't mean you have found the end of the tunnel. It could just be a freight train coming at you, run you the hell over. So, I've been saying continue to look long, that we were just in a bit of a pullback and it was likely that we were going to come out of it. That's not proven yet, right? We haven't come out of it yet. But as we're going to see in the charts, this is the kind of setup that I was talking about last week. The long pin bar reversal, the big gap up, and the start of the push for some setup like a TRB setup or a Morningstar reversal, 3-bar swing low, whichever one of those you want to call it. It's not yet a non-standard complex swing low. It didn't get that bad, but so far it's straight out of the textbooks. So, we'll take what we can get. Markets seem to like what's going on. Japan's basically flat. Hong Kong right behind it. Then everything else. Now Europe's up the most, and we want to be careful today when Europe closes. When you see this, we've seen it before. Everything travels around the world. So it starts in Asia, then we get into Europe, then in the US. If a lot of our buoy this morning comes from Europe and then Europe ends, we'll lose that boost. It doesn't mean we're going to go down, but it could end the drive that we see through the morning and we could stall out, maybe fade back a little bit. So just keep your eye on Europe's close. Market opens and closes around the world just give me a lot of trouble. And I found this website. It's free. It doesn't cost you anything. It's called tradinghours.com. I like free, right? There's so many places out there that want to sell you something, force you to sign up, give them an email so that they can sell it and barrage you with a bunch of trash. You can go here. You don't need an account. You don't have to sign up for anything. It's free. And you can check market hours from around the world. It'll tell you the time zone of that market, so you can check it against it. It has holidays for that nation. It'll tell you about economic events for that nation. It's a fantastic website, and it's all free. So that's called tradinghours.com. Just Google it. You'll find it. It doesn't require anything more out of you than just going there. And this is one of those resources that you want to just put in your pocket and hang on to, right? The more you trade, the longer you're around, you're just going to gather all of these different tools and resources. And this is one of those. So just, I don't know, put it in whatever pocket you put it in. I've got a couple of them. Something like Raindrop IO is really good if you're looking to organize all of your bookmarks. But put it somewhere so you don't lose it. Time change doesn't just happen in the US. So that's something to think about as well, right? Being able to keep track of different markets. To me, it was always the holidays in those different markets. I barely keep up with US holidays, let alone somebody else, some other nation's holidays. So keep your eye on Europe's close. See if we get a change in market dynamics after that close. It wouldn't be the first time. And on a day like this, that's what I'm expecting at the moment. For us to stall out at that point and retest, see if we can do it on our own without Europe. And if we can't, then fade back maybe to the half back of today's drive, whatever we happen to get through the morning session. Market Watch doesn't have anything for Monday. This website is really just the big ones, and it's only for US. So it's not a comprehensive list of things that are happening today, but I like this one because it's not cluttered and it only shows me the biggest things for the day. And if there's nothing scheduled, then I know that there's no big economic event today. There may be smaller ones that we can see on this calendar, but they're not considered big enough to land on Market Watch. Looking at FX Street, we've got some auctions in the front end. Probably just use something like IRX. Then really that's it until we get into tonight. We could see something through the overnight with the trade balances. You know, maybe we hear something out of them tonight and we see the response into tomorrow morning, but that's a tomorrow problem, really. I don't see them trying to front run it. I thought I heard something about president speaking, so it's not showing up here, but check that. Make sure he's not going to be speaking today. Otherwise, fit that in wherever it fits in here. And of course, tomorrow's a holiday. Markets are open, but House and Senate won't be, right? So even if we do get an agreement, there's not going to be any resolution until at least Wednesday, and very likely longer than that, since the House is going to want to throw a fit. Besides, even the Senate itself, there's procedural hurdles that others can throw in to slow it down, not stop it, but slow it down in the Senate for a few days. The VIX closed back down below 20. It's kind of that generic line in the sand. Now these lines, you know, I got these a long time ago from David Keller over at stockcharts.com. He was doing a video once about the VIX. You could probably find it. It's on YouTube. Just type in stockcharts.com VIX, maybe add the words David Keller. But he did this little rant about these levels that he uses. And they were so generic and so simple. I thought, well, that's fantastic. And I added them to the chart a long time ago. And just keep them around. $20 is basically that line in the sand where if the VIX gets above it and we keep it, then we're not just in a pullback, we're in a deeper correction in the market. But once we get back underneath that 20, then we're just in a more simplistic pullback. It's not as simple as that, really. It's not, right? But if we keep it that simple just for analysis and conversation, then it works. The reason it's not just as simple as that is because of these funds called VC funds, volatility control funds. And it's just like it sounds, volatility controls them, how much they allocate, whether they remain net long or they start to reduce their longs or they straight up go short. It's all predicated on what the VIX is doing. It's non-discretionary. They get no input on whether they like it, whether they think it's going to last. Once the VIX gets and closes above a certain level, they have to respond. And when it gets back down below a certain level, they have to respond. So VC funds are why these levels are so perfect, right? Because there's no reason to get complicated. You can just have a very simple line in the sand and everybody's on board with it, because, you know, there's a lot of stupid people out there that just can't manage complex concepts. Hiring people that can manage complex concepts is expensive. So what does a firm do? Keep it simple. Ta-da, done. Well, that meta just keeps on spending and spending and spending. All right, so taking a look at the daily, we talked about this last week. That thing's just a quitter. Come on, you can do it. That's the way I draw it in all of my journal work. You've probably seen me draw it before. You get used to it after a while. It's that rope-a-dope move, right? Take it from Thursday into Friday, that big run to the downside, and then really it wasn't that beautiful of a reversal, but we had that reversal and the run back up, and it closed very strongly against the highs of the day. And then we continued that drive with a gap up, and we left that gap unfinished, right? We can see that down here. Some analysts will say that if price got to the previous bar's level, then the gap is closed. As long as these two numbers match, the gap is closed. I am not that kind of analyst. If we closed right here, and that is where we closed, then this gap isn't closed until price gets back to this level. That's just kind of common sense, right? How can you close the gap if you didn't get back to the last place price was? Seems simple enough, but a lot of analysts do it the other way. You do you, right? There's no wrong way to go, and I'm not necessarily saying they're wrong. I'm just saying they do it in a way that I don't. So as far as I'm concerned, this gap is not closed. We may end up having to go down there later and deal with that because markets don't like to leave a gap unfilled. But that's a tomorrow problem as well. We got our gap up. We got an attempt to close the gap. Now we've made a run for it, and we're dancing with that 10. Now we're trying to get a surge signal here. A surge signal is when price crosses through the 3 and the 10, and as it continues to drive higher, it drags the 3 through the 10, and that's our surge signal. It can be bearish or bullish because you can flip it around and do the same analysis the other way around, like back here when price broke the 3 and the 10 to the downside and it ran lower, which dragged the 3 through the 10. That was a bear surge signal. So we're getting the flip, and then there's these pop points. Can never remember. Rob somebody had this concept about where stops are placed, and it's a pretty generic concept, but the argument fits. Not necessarily in the ES, but think equities, right? Like if this was Apple, Microsoft, or even just the ETFs, SPY, the Qs. If you were short, generically speaking, you would put your stop above the previous bar's high. So there'd be a lot of stops above this level and a lot of stops above that level and that level, right? You get the idea. So once we start going long and we trigger into those stops, well, if you're short, the stop that you're using is a buy order. Simple concept. We run up, we land into a bunch of buy orders that fuels the buying, pushes us even higher. We get into the next level of stops, which is a bunch of buy orders that fuels us higher. And we can get what I call a TRB, trend line breakover. Anything that gets us back up to this previous level would fit. But how we get there, a TRB is supposed to be like one single bar, maybe two. That's what makes it so awesome. And historically, if we go back and look, there are a lot of examples where we get this sort of setup and we get the breakover and we get one bar that runs us right back to the top. Oh, I love that. If we don't do it in one bar, it can still be a TRB, but it's better to call it something else. Because if we come down here and we build a bit of a base and then we come over, well, I mean, look at it. It's a big old cup. And from that cup, maybe we get a handle and then we continue on. If we get back up and we overshoot it and stall, then we've exceeded the previous high with a new high, and it can be a bull trap, and then we come on back down. And that would be a double bottom, a double top. It's the way I run both of them. Double tops, double bottoms need to exceed the previous high or the previous low. And then, of course, we can just V. Even if we V and we get candles all the way back up that look about this size, we could just get another one and another one and another one, work our way back up. Technically, I wouldn't necessarily call that a TRB, but it would fit the concept. It would just be getting us back up to that previous level. How we deal with things up here is going to be the key, whether we overshoot it and stall, or we stall out before we even get there, maybe get something what Adam Grimes calls a pre-consolidation breakout, which would be that price stalls underneath this level and begins to consolidate right in here and then has enough power to push through and really break to the upside with a new expansion. To figure out how far that expansion should go, just a simple fib snap, and you got your 111 and your 1, 2, 3, 6 right up there. If we're going to stall and fall, it should get hung up around that 111. If we get through that and we get all the way up into the 1, 2, 3, 6, it's more likely that we keep it. But I mean, there's plenty of examples where we hit the 1, 2, 3 and we still ended up falling back down. Just saying, though, it's more likely that we keep it if we actually get there, especially how we close once we get there. If we get there and immediately fall and we have a candle that eventually closes back around that orange line, yeah, it's more likely we're going to fall down and test some previous levels. But if we get up there and we close at that line or even a little above that line, it's more likely that we keep it. So game on at this point. We just need to play it out, right? We already have the inside day breakout. That has to stick. We don't want to give that back at all today or else. From here, it's all about how we get back to the top. If we don't make it back to the top, if we set a lower high and we fall off of that lower high, because that's the high that we're focused on, anything lower than that, it will only be a lower high if we get there and then we leave it behind significantly so that we can look back and say, oh, look, that was a lower high. If we just get there and we have a red morning and a red afternoon, and then before the close, we run back up, then it's not going to count, right? It can't just be some one day wick like that. It needs to be enough that we look back and say, we got a lower high. That won't be good, because then it'll turn this whole thing into another complex topping pattern where we're not quite sure if it's going to break to the upside and move on or if it's going to stall out again. That would put us back into sort of this scenario where we had a high, then a new high, big drop. Then we got this, which was that lower high, had us in this topping pattern for a while. And then we finally came out of it to the upside. But it was quite a lot of unknown when we were hanging out in here. It wasn't that long ago, surely you remember. So we're looking for this to be a nice, clean move. Maybe something like this or akin to it. If it's a lot of bars, that's a really good example. If it's a single shot, well, I don't know. I've got a lot of examples. I just don't have any pulled up at the moment. I would take the TRB though, if we get it. Happy to have it. So lay that out into today's trading. We've already made the run. We're stalled up against some options levels. We're at the 3, the 10, and the 20. All those levels are right here with us. If we can get above the 10, there's nothing left since all the moving averages are either here or below. So we have a clear shot, just options levels and drawing levels overhead. $69.50 does not look very far away from here. Even the call wall at 70.20 something is a long ways off. So we're not even going to hit that. Got an options level around 73 and then 20-ish. Overnight volume at 94. I mean, it's a little better than Friday's volume, but it's a little light compared. Still, for our average of 50 to 60, 90 comes in a bit heavy. So they weren't sitting out. They were in there and they were participating. The kill zone last night was that push to the upside, and we never gave it back. And it was kind of late, wasn't it? Kill zone should have started around 132, and instead we got this drive around after 3, turned us back around. I don't know. I wouldn't contribute that to the kill zone. The time is off. $68.32 cog line is the ADR half. It's very likely that that's all we get, and we just hang out here for the rest of the day. It doesn't owe us anything. We've already got the gap up. We've already got the run. It's a beautiful move. Stalling out here and just keeping it for the day makes sense. Now, I'm not saying that's what we're going to do, but at this point, we don't need anything else. It would still be considered bullish. I would tighten that range, though. We don't need from red line to red line. I would use something like our own Globex low and our own Globex high up into that red line. That having that be our range today makes perfect sense to me. Now, if we get out of that to the upside, 68.32 breaks, then we'll run it to the ADR full. As I've mentioned before, if we break above that yellow line today and we continue to drive to the upside, bring up the SPX because it won't get these lines until 9:30. And what we've seen in the past is if the ES breaks these levels and continues to run, if you bring up the SPX, once that market hits these levels, then we get our stopping point, right? So it's a nice tell, even if you're trading the futures, to swap over and check that SPX level and just continue to ask, are we there yet, right? Like kids in the back seat, we there yet? Are we there yet? We're not there yet. Another thing that you can do is just measure the distance and plot it up to the next level. Doesn't have to be perfect. This is 50% higher. You can do it the way that I just did measuring from red line to red line, or you can just measure between the red and the yellow and set it up there. You get the same answer, either one, right? Not a game of perfect, but if you notice, it gets us up into this area, 69.11 cog line, and that resistance up there. It's a little low, but you get the idea. That matches. Yeah. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish, but we've run through it. We are above it. And so we've removed all of that negativity. It's still below us though. So if we turn and say get an inverse TRB, then that's the target first. Get to that floor pivot, then get the gap closed, and then focus on this pivot point, which is probably the floor pivot. Nope, we got that backwards. All right, hold on. This is the weekly pivot. This is the daily pivot. Today's pivot is lower than yesterday's, but price opened above it. That's bullish. But it's an MDP, missed daily pivot. So it's likely that we come down and hit it. Now, we had a missed daily pivot on Friday. And now, so far today, we've got another missed daily pivot. And I believe in the videos, the guy talked about this. But it's been so long, I don't remember. Because this is not a common setup where you get back-to-back missed daily pivots, but we're opposite of them. Still, I would see that as a transition piece, and it so far fits with the gap up push that we're seeing. So I like it. We are back above the weekly pivot, so we want to focus on that. Above the weekly pivot is bullish, and of course, being above our own daily floor pivot is bullish. One thing we got to worry about, though, is the S&R lines. So we're above R1. Took a little bit of work. You can see how we stalled out when we got there. Finally, we made it above. So, okay, we're above. We need to keep it. If we get back down inside of this red line, then we could get back to the daily floor pivot. Underneath that, and we've got S1. R1 to S2 is common. I'm not saying we're going to S2, but I am saying going from an R1 to S2 is common. So, it's level by level. If we break back inside this red line, aim for the weekly pivot, back inside that, we go for the daily pivot, and then S1, and then S2. It is worth noting that the indicator is strongly pointing to the upside. The distance between the floor pivot and S1 and the floor pivot and R1 are the signal to identify if this indicator thinks we're going to go up or down, whichever range is bigger. There's a lot of noise on here, so I'm just going to remove that for a moment. You can very clearly see the distance from floor pivot to S1 and the distance from floor pivot to R1, which way the indicator thought the market was going to go. Up. Now that indicator doesn't make price do anything. It's just a signal towards what's more likely, that we go up or that we go down. All right, we are at last week's point of control. This is an ugly development from last week. You look at this distribution, we've got these zones all over the place. So if we can get through the current zone, which happens to be the biggest one, then it gets pretty shallow and then it builds back out right around 6,900. they took a front run on that 6,900. So watch for 68.92 cog line. That's going to be your biggest area once we get through this point of control, which right now we're through it, but we're dancing on it. So, you know, let's get far enough away from it that there's no doubt left on whether or not we're going to keep it. And then it gets more shallow on the run back up. So the higher we get, the less footprint we have to deal with until we get out of the value area. Then it starts to build back out again into that 68.92. So we should be good into like 68.60-ish. Above that, we got some headwinds. Match that up with the dealer levels and see what's up there above 68.60. That way you get some confluence. Dude, I was in Houston when they had just a little bit of frost. I mean, just a little bit of frost. The whole city shut down. They were driving into the ditches, launching themselves off of the on-ramp. It was an absolute hoot to watch. But, you know, as much as I like to talk trash about Texans not being able to drive and Louisiana, their roads are curved. They're sloped on the edges for water to run off. So if you put just a little bit of ice on them, what do you think the cars do? They just slide into the ditch, right? It's not necessarily because of the skill of the driver. The roads are curved. They're like a ball, right? A rounded top. So it's fun to make fun of them, but there is a reason for the shenanigans to some extent. Not the people that I saw trying to drive up the on-ramp, getting a running start to try to beat the ice and then launching themselves onto the interstate. We got a new VPOC for Friday. I'm going to use the round number 6703, but you do you if you want to dial it in to the tick. I'm not sure how my weather is because I'm not going outside to find out. One of the benefits of working from home. I know I'm going to have to grow everything in the garage because I think next spring's going to be trash. All right, we can see this morning they're putting in some work up here. So if we drop back down, we got 6802. Through that, it gets a little shallow, and then back into where we opened last night. We got a little bit of a footprint. Otherwise, we've got 2 levels overhead to watch. One from the 3rd and one from the 5th. 6850, which should already be on your radar, and then 6884, which is really close to that old cog line that we don't use anymore, 82. All right, last Friday, we examined the weekly expected move for this week, and we laid it over last week's range, but it was only a preview because the market hadn't closed yet. And all day on Friday, this box was moving around and growing and shrinking. And so on Monday, we always have to come back in and do the measurement again and see what we actually got. This week's range is slightly bigger than last week's range. And obviously I'm not getting it to the tick perfect because we don't need it. The implication is that if there was something big on the radar, CPI, PPI, non-farm payrolls, FOMC, something the market saw coming but didn't know the answer to, it's what we call a known unknown. If we had something like that coming this week, the market would anticipate a day and a half of sideways, and we would have a narrower range. So yes, a narrow range implies a lack of volatility, which makes you think, oh, a narrow range, there must not be anything big on the agenda for next week. Otherwise, they would price in volatility. But it actually works the other way around. If there is something big, then the range will be narrow because they'll expect us to go sideways into that event. The fact that this week and last week are around the same size, or that this one's a little bigger, implies that they don't see anything on the economic calendar that would cause that hurry up and wait scenario. Instead, they see enough volatility out there in general that they're pricing in the possibility of some pretty good moves, and that it's not connected to an economic schedule. It can be the idea that the government shutdown ends, for an example. That could cause volatility to the upside, and they could be giving it some width for that. That's just one example out of many, but it fits. I don't think this shutdown is going to end before at least Friday. And how long is it going to take before the market gets disillusioned by the news and finds out that it's not as good as they thought it was based on the headline? Looking at our distance from 10 on the daily, we're at the 10. I know you can't really see it in the live stream, but we are right here. We're not here, right? That's where we were on Friday. So with us being right there, we are at the 10 on the daily. That means we could easily move 1% from our current location, and we're already up 0.94 this morning. We could go another 1%, and it still wouldn't be overbought, overextended, or any of those words. We've got plenty of room. Now, it is worth asking the question, if we make a 1% move, would that get us to the edge of the weekly expected move? Nope, through it. So a 1% move would get us up into the 85 area, 68, 85. That'd be a breakout on the week. Wouldn't be the first time we had a breakout and then wasn't able to keep it. Right? We broke out on all three of those days above the weekly expected move. We still didn't keep it. All right, and looking at the weekly, we're still 1.5% above the 10 week. So it's a good place to be. We've been getting these lower highs. We don't know yet if this is going to end up being a lower high or not. So we need to see something lower. And then, to look back and say, yeah, look, that was a lower high. The day is still open. So we could just continue to run for all we know and end up printing a higher high. We don't know yet. But it has been stair stepping down. So we got to see what's coming next. But at some point, this is going to wedge, and then we should break and expand. It can expand down as easily as it can expand up. So that comment isn't necessarily bullish by itself. So this setup from Friday into today is about the best setup that we could have asked for. I mean, it is textbook perfect. But it is worth mentioning, it doesn't matter how beautiful it is, it can still fail. Headlines, gotcha news, anything can do it, right? So trading has risk. It just has to be said. I talk to people every day who just can't seem to get this idea across. They think there's some trades that are just foolproof, and it doesn't matter how good it is. The darn thing can lose anyways. Look at the things that are down. Basically, bonds are down, at least according to Thinkorswim. But look, I don't trust Thinkorswim when it comes to HYG, SHI, TNX, TLT, especially not in the morning. That's one of the reasons that I use the 10-year futures rather than the TNX. Use that one. At least if you're on Thinkorswim, right? TradingView does an excellent job with all of these, so you don't have to worry about it. Looking at what's up this morning, China, Mag 7 up volume, precious metals, metals miners, uranium, Bitcoin chips, quantum, metals and mining, Mag 7, tech again, UFOs. So we're getting some of those small cap rotation into this. Bots, China, solar, expanded tech. Yeah. Basically everything, right? So when we have this scenario, one of the things that you want to do, that's a look at breadth, basically. Narrow it up some. Now, once the market opens, you've got your advanced decline line on Thinkorswim, and that's fine. But we want to get lined up before then, right? So what I like to do is use that 0.5% and ask the question, well, how many stocks are up in the S&P 100 at least 0.5%? If this is above 60 or 70, then we're crazy bullish, right? And it's not. It's only at 40%. 40% of the S&P is up 0.5% or more. Okay, I mean that's mildly bullish. And remember, what stocks are up matters more than how many are up. I know it shouldn't be that way, but that's the way it is. Because if the 7 are up, then nothing else matters, right? You can let the other 490 take a nap as long as you've got at least the top 7 names, the Mag 7, doing their job. And we can see that they're in here. Meta, Google, Microsoft, Amazon, they are in there. So they're getting it done. We don't have every single one of them. There's Tesla. So it looks like we're missing what? Apple? Yeah, basically. But we've got enough of the others to get it done. Because there's NVIDIA. Yeah. We got enough of the Mag 7 to push it. But we can still look at the other side. How many names in the NASDAQ 100 are up at least 0.5%? The answer is 55. So 55% of the NASDAQ is up at least 0.5%. That's pretty good. You're over the hump, right? You're more than 50. Crazy bullish would be getting into the high 60s or the 70s, but it's still early. So what you want to do is after, say, 9 o'clock or even after the market opens, I think after the market opens would be better so that you can use this. Go to the Market Watch tab, choose the Visualize swap that out to the indexes and then pick your index. You can do, I like using the 100 instead of the 500 on the S&P and the NASDAQ. And these are detachable, right? And you can stack them up, keep it all nice and tight so you don't have a lot of clutter, pin them so they don't fall behind. And you can make these tiny little windows just like that. I mean, that's a pretty small footprint right there. And you can do that with your own homemade indexes as well, right? Like you can make a Mag 7 one, or you can just build out, say, credit cards, airlines. It doesn't matter, whatever you want to build out, right? But by default, Thinkorswim has the Dow, the Russell, the NASDAQ, the S&P. So you could put all of those in there. And once the market opens, you can see how many companies, I know it says issues, but companies, how many companies are up versus how many are down, and you can see the money flow. So if there's any divergence within the capital, because you can have more stocks going up than down, but more money going out than in, and there'd be your divergence. Cool, cool. If we're going to lose it, you'll see it here first, right? If it all starts to unwind, it would start to show up in the advancing minus the declining issues. I say first, but you know, that's technically that's not true. We'll have a lot of other tails before that, but that would be your broader, you know, rubber stamp, seal of approval kind of thing. Otherwise, get those numbers on the bullish side, get the advancing up to like plus 90. It's crazy bullish. You get above 95, you can run your alpha protocol. I'm a bit picky. I like it at 97, but you do you. So that's what I got, guys. Be careful, be safe. We got the play started. We got to see how it plays out. Remember, this is all headlines. So headlines change. All of this is going to change because we don't have anything yet.